What's going on, guys, and welcome back to another very exciting video. Today we are talking about one of my favorite stocks in the stock market, and that is Google stock. I personally do own Google stock. Keep that in mind as you are watching this video, but I do love the company. I think it has a lot of potential going forward. So in this video, we're going to be taking a look at what Google can do over the next 6 months to kind of help its business and put its business in a better position. And then we're going to take a look at the broader stock market and what happens coming out of a recession, or as we have kind of entered into a recession. We're going to take a look all the way back from 1957 till now and basically come out with a few different projections of what has happened in the past and what could potentially happen now. Specifically in the 1980s, we saw a very similar situation to what we are seeing now with very high inflation and very high interest rates. So we're going to take a look at that. That is going to be very exciting at the end of the video. So stick around till then. If you do like the video, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Before we get into all of that, let's take a look at Google's chart. So here on Friday, they were down a quarter of a percent. Over the last 5 days, they're actually up 1.3%. Over the last month, down 12.63%. A lot of stocks have been beaten down in a very massive way. And we had a huge kind of move up over the last 3 months or so, where the stock market went from, all-time lows up to, somewhere kind of in the middle ground. And now we've started to see some reversion of that back to all-time lows. We are a little bit actually off of all-time lows. We can see here that Google stock got all the way down to $83.43. So we are still around $5 off of that mark. And over the last year, we can see that Google stock is down almost 40%. So it has been beaten down in a very massive way. We can see that its 52-week high down here is sitting at $151.55. And its 52-week low is again around that $83.34. One thing that is very interesting with Google stock right now is its trailing PE ratio and its forward PE ratio. So its forward PE ratio, which I tend to look at, is actually 16.64, which is extremely low for a company like this. We saw a year and a half ago that it was trading closer to like a 30 forward PE ratio. And we could even see that, around a year ago, it was actually trading at a 25.64 forward PE ratio. But if we look at the trailing PE ratio, this is very interesting because we can actually compare this to the S&P 500 right now. And we see that Google right now is trading at a 17.68 trailing PE ratio. And if we jump over and look at where the market's sitting at, the market right now is trading at a 20.27 forward PE ratio. So Google is even trading below where the market is at. And that shows in its numbers because it has been hit in a very massive way. Like we saw, the stock is down 40% over the last year. There are a few factors going into why Google has been hit in a major way. And I kind of have them highlighted right here. So it's a combination of slowing growth. We've seen a revenue growth decline from around 30% revenue growth to around 6% quarter over quarter. We'll take a look at that here in a second. And then falling profits and compressing valuations. So valuations for the tech sector have fallen in a massive way. We just looked at that going from a 25 forward PE ratio all the way down to a 16 forward PE ratio where they're trading at right now. And clearly based off the market, that is actually undervalued, even for a Google stock that has traded, above market valuations in the past. Here we can see the revenue growth over the last few years. And really what's interesting, again, coming out of 2020, there was an extreme amount of growth. So they grew 14%, they grew 23%, they grew 34%, and then they grew 61% revenue year over year, which is absolutely insane. Again, this number though is comparing against this very low number that we saw in 2020 when we actually saw a negative 1.66% revenue growth. And then what investors are really worried about is this decline that we're seeing on the back half here. So they only grew 41% and then 32% and then 23% and then 12%. And now what is kind of worrying investors is only 6% growth over year. And really the only time we've seen that, other than obviously this 2020 crash, was all the way back in 2013. They were growing single digits here for the September quarter, and that was 3.38%. One thing that has come up over the last 3 months or so is employee counts. So we have seen companies like Twitter, Amazon, Meta, all reduce their employee count over the last 3 to 6 months, and they've reduced it in massive ways. But one of the top offenders of employee count is actually Google. So Google in 2018 had around 98,000 employees, and now in 2022 we are seeing a projection right now. I've looked up some of the numbers, and they're sitting around 187,000 employees. Here in 2021, we can could see that they were at 156,000. So they've grown another 30,000 over the last year or so. And really, when you think about the business model behind Google, they really haven't changed a whole lot, right? They have a 92, I believe, percent market share in how people search the internet, which is obviously through Google. Bing obviously has some of the other percent, and then there's a few other players, but they are mainly the top dog, being Google. And really, their business has not changed a whole lot. They advertise a lot. You see all these ads that are, posted throughout websites. And really that hasn't adjusted over the last 3 to 5 years. So the question is, where are all these employees going? What are they working on? What are they doing? And how is that contributing to their top line and bottom line growth? So that's really what people are going to want to see. They're going to want to see results out of these employees. And if we don't start seeing results soon, they want to start seeing a reduction in expenses, which would be reducing headcount. So that's something that over the next 6 months, if Google starts to turn around and do, we could see a pop in the stock just from that reduction in headcount. We're going to close out the video by looking at the S&P 500 and some very interesting statistics that we have here. So the S&P 500 has been higher 3 years later in 8 out of 9 cases in which the index has fallen 20% or more from all-time highs, going back to 1957. Stocks have returned an on average 29% during those 8 cases. So here we have a very nice chart, and we can see what's happened 6 months later, what's happened a year later, what's happened 2 years later, and what's happened 3 years later. So 3 years later, we could see that 8 out of these 9 cases, the stock market has been up. The only one that we're missing is 2020. And obviously right now we're sitting down from 2020 even. But over the next year, if we recover a little bit, we'll be up. And that case will be, the 9th out of 10 cases that have finished in the positive. What's interesting, again, 2001, we had a huge crash from valuation. So I'm not surprised at all that that is lower by 6%. Again, in terms of just the S&P 500, if you were smart with your money and invested in a lot of companies that, had actual EPS, had earnings, I'm sure a lot of those companies were actually higher, but because so many companies got their valuations just inflated to incredible numbers, they all got basically moved into the S&P 500, and then a lot of them just went bankrupt. So it's no surprising, again, that this number is lower. And then we have some, relatively low returns here in 1973 of 7%, and then here in 2008 of only 6%. I did want to pull one case in particular from this chart, and that is in the 1980s. So at the start of 1980, we saw a similar situation to what we are seeing now, actually even more severe. So the Fed increased interest rates in a very massive way. They increased them to almost like 20%, and then they started to kind of back interest rates off, and then they had to ramp them back up, and then they had to back them off again. So it was a very up and down type of market. And we could see that even at that time, all of these percentages are positive. So in 6 months, there was a 1% return. In 1 year, there was a 32% return. Over 2 years, there was a 40% return. And over 3 years, there was a 62% return. So very interesting. And when we jump over here, we can see what was actually happening in terms of interest rates. So again, around 1980, interest rates were all the way up here around 20%. And then they dropped the rate in a very massive way in a very short amount of time to see if they had kind of curbed inflation. They hadn't. They dropped the rates all the way down here. You can see around 9%. And then they had to ramp interest rates all the way back up, which forced us into this kind of recession that you could see throughout 1981 and into 1982. And then they basically started ramping down interest rates over that year. So we could see that the Fed in this situation acted very quickly, right? They ramped up in a very massive way, really beat down the inflation very quickly. And then, basically we saw stocks start to correct in a good way after that, like we saw from the chart there. We saw a 62% return over the next 3 years. And, basically interest rates continue to drop over that time period. The Fed, obviously, in this situation has ramped at a much slower pace. So they have still ramped in a very massive way compared to, 2016, 17, when they ramped very slowly. But here you can see they ramped up interest rates again over the last 6 months to year in a very quick way, but not as quick as what we've seen in 1980. So maybe that could have some some effect on, how the stock market actually reacts. But if we start seeing inflation come down in a very quick way, which I've done a video over, I think over the next 3 to 4 or 5 months, we could actually see inflation drop by another 1.5%. And that could kind of start the Fed thinking, okay, maybe we need to slow down our increases or even pause our increases and just let the Fed rate kind of sit at where it's at and potentially start taking more of an effect. We've looked at in the past how inflation and interest rates kind of interact, and it takes a number of months before you actually start seeing the effects of increased interest rates. So that is one thing that the Fed will keep in the back of their mind. And, over the next year, maybe they keep interest rates kind of level, or maybe they even start bringing them down in a small way just to kind of curb the potential of a recession. So overall, those are kind of my thoughts on the market right now and where we could see things going. I want to end off the video by taking a look at the S&P 500 over the last year and kind of just going over what's happened so far. So again, at the start of the year, there was a lot of scares about the Fed increasing interest rates. So we saw the market decline in a very substantial way. And then we also had the Russian and Ukraine war. So that really scared off the market that there could be a big war where a lot of people start getting involved. It really hasn't turned into that. It's really been a very isolated incident where it's basically just been Ukraine against Russia with, some outside support from different countries. So we saw the market continue to decline kind of throughout those events. And then we saw the market decline in a massive way over the spring and summer as the Fed began to increase interest rates in a very massive way. We saw a number of 0.75% increases in interest rates, and the market did not like that at all. That allowed for the market to decrease, to lows that we saw back here in June. But then coming out of that, we started to see interest rates or inflation rates level off. We saw, numbers kind of level around that 8.5% inflation rates. And then, the market kind of saw a few declines in a row and overall it reacted in a positive way. But then we turned around and we saw earnings numbers start to come in. And as those numbers started to come in, the market did not like what it saw. A lot of that being on the back of, negative projections over the next 6 months to a year. Money was getting tighter for a lot of these companies. So a lot of these companies came out and they basically said, hey, the next year is going to be rough because we are not going to have as much capital to invest. People are not spending as much money. We saw Google in this situation. We saw Meta in this situation. We saw a lot of these big companies kind of starting to look at what it'll need to do to cut costs and really keep their numbers up. And that really, again, tanked the market back in here. And then we saw inflation numbers drop by around 1%. So there was a lot of, positivity that the Fed could potentially start just leveling off interest rates or even decreasing interest rates. And the market reacted in a very positive way. And then over the last month or so, we have seen the market decline again, a little bit. It's not back to its all-time lows. It's fairly off of, the all-time lows. We would need a few, maybe 5 to 10% more decline to get back to these all-time lows. But overall, that's kind of how the market has reacted over the last year. I hope you guys have had a good year, a good 2022, and I hope we have an even better 2023. Overall, I hope you did enjoy the video. Again, remember, I am some random guy on the internet. Do not take any of this as financial advice. Do your own research before you buy into any of these companies that I talk about. But again, I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And as always, guys, have a wonderful rest of your year.